Welcome back to our accounting sessions, and what we are going to be looking at in this session will be the topic of takeovers. And previously you were introduced to the partnership accounts and how to account for anything with respect to partnerships. And after you were introduced to partnerships and their accounts, you were also then introduced to the fact that the composition of a partnership can change for various reasons. For example, a partner may retire from the partnership, and then the partnership agreement will have to be renegotiated and a new partnership agreement come into effect for the new partners. Also, we looked at how you would account for the change in the partnerships, and we looked at the fact that if a partnership can change at the beginning of a financial year, it can also change at the end of a financial year, but more importantly, the partnership can change during a financial year. And we looked at the fact that if the partnership changed during the financial year, then you will have to split the income statement and the appropriation account for the partners to deal with what occur or the transactions that would have occurred under the old agreement when all the original partners were there, or when the original partners were under a different type of agreement, which we will call the old agreement. And then you would have to account for what occurred after the change with what we will call a new agreement. So those are the things that we looked at when you had the partnership change. And then we moved on to say that a partnership, we have the partnership composition changing, but we also look at the fact that for various reasons, the partnership can then come to an end, which we call dissolution of partnerships. And we say the partnership can come to an end for various reasons. For like example, the business may no longer be profitable, so the partners decide that they're going to bring that business to an end. It can be that the partners cannot agree on how to actually effective and efficiently run the business, so they decide to go their separate ways. So there are various reasons where the partnership can come to an end. So that's why we look at dissolving the partnership. And when we looked at dissolving the partnership, we looked at the fact that you have to close off all the accounts for the business on the books of the business when you are closing the business. So for example, all your assets, your liabilities, all of those things will be closed off because the business is coming to an end. And we looked at using three accounts: the realization account, we looked at closing the capital accounts and closing off the current accounts for the partners if there were current accounts to the capital account. And we also looked at using the cash or bank account to complete the closure of the business. After we looked then at the dissolution of partnerships, we also talk about the fact that businesses can amalgamate or merge together. And we talk about the fact that a business can, one or more businesses can come together. And we looked at the fact that a sole trader can amalgamate with a partnership. We looked at partnerships can amalgamate with each other. And obviously, companies can also merge together as well. And in partnership changes, we would have looked at the fact that when the composition of the partnership changed, they would revalue their assets. And similarly, we looked at in amalgamations that the assets of the partners will also be revalued, or the separate entities, that is, will be revalued, and you have to do revaluation accounts for those separate entities. And we look at the fact that then you will have to combine the assets and liabilities of the two entities into the statement of financial position for then one entity. And we also stated that when they amalgamate, the old businesses cease to exist, and then you have a new business being formed. So since we look at amalgamations and we look at dissolutions and we looked at changes in the composition of partnership, what we are going to be looking at in this session is the topic of takeovers. Now, a business can be taken over by any other business. And what usually occurs is that the taken over business will no longer trade as a separate entity. So let's say, for example, you had business A, and business A decides that it will take over business B. What would happen is that business B would cease to trade as a separate entity because it was taken over by business A. So again, a business can be taken over by another business, and generally the taken over business will no longer trade as a separate entity. Now let's look at partnerships takeovers. Now a partnership can be taken over or sold to an existing company. So that is what can happen. So let's say you had a partnership. That partnership can decide to sell their firm to an existing company, or an existing company can come in and decide they're going to take over the partnership firm. On the other hand, the partners can decide that they would incorporate, or they would create a company, and that company would take over their partnership. And the reason that they would do that, because they will want to enjoy the benefits that that business structure provides. Because with respect to a company, you will know that the liability of a company is limited. However, when you remember that the sole trader has unlimited liability, and a partnership also has, the partners in a partnership would also have unlimited liability. That is to say that if they cannot settle their debts, the creditors can come after their personal assets. So maybe the partners don't want to have that form of, or that type of structure of a business anymore, and they want to enjoy the benefits of having that limited liability where creditors cannot come after their personal assets. So they decide, well, let's create a company, and in creating this company, we are going to then let this company take over the partnership. So this is something that can happen as well. Now, the benefits of partnerships takeovers, I'm going to give you two benefits of a partnership being taken over by a company. One is that the company has a limited liability, as stated previously, and the owners of the company are only liable to the equity that they have invested. So the owners of the company are only liable to what they invested in that company. So therefore, their personal assets are actually protected because that they are under that veil of incorporation. Secondly, the business can exist after the death of the owners or retirement, etc. So remember, with a partnership, if one partner dies, that partnership ceases, and then they have to do a new partnership agreement to bring a new partnership into being. However, when you have a company, even if the owner dies, the business still continues to go on. If the owner retires, if the owner gets sick, the business continue because the business has its own separate identity from the owners. It's a separate entity. The company is a separate entity, so it will continue to exist. So let's look at when you are taking over a business, the fact that you actually have to pay a price for taking over this business, which is called the purchase price. Now, the company taking over the business, what they can do is that they can opt to pay for the business in cash or by issuing shares, and they can issue those shares at par or premium. And when we say premium, we mean they can issue them above the par value. And let's go back to our foundation or our introduction when we did accounting and we were introduced to companies and to shares. And you had two different class of shares, your ordinary shares and your preference shares. Now, when a company is formed, they have articles of incorporation or their memorandum, which is legal document. And in that article or in that memorandum, it is stated what the authorized share capital of the business is. So let's say, for example, the business is authorized or can trade a maximum of 100,000 shares on the market. Also, it is also stated the value that they will sell those shares at. So they can say, well, I would like to sell up to a maximum of 100,000 shares, and we're going to sell them at $2 each. The $2 would be known as the par value. So that is what they're selling them at. However, when they begin to issue the shares to the public, they can decide that they're going to sell the shares at the $2 that is stated in their articles of incorporation, or they can decide that they're going to sell them for more than $2. And if they sell them for more than $2, then they're selling them at a premium or issuing them at a premium. So let's say that they decide to issue them at $2.50. The $2 is the par, but the 50 cents is the premium. So again, the company taking over the business can opt to pay for the business in cash or by issuing shares or possibly loan notes, or they can do that by a combination of cash, shares, and loan notes. And when the business is paying for the taken over business, this is what the purchase price is also known as the purchase consideration. Now let's look at purchase consideration and how we would deal with this if the purchase consideration is, for example, let's say shares were being issued. So let's say that business A is taking over the partnership, right, of X and Y. So business A is taking over the partnership of X and Y. So, and they decide that they're going to issue ordinary shares to the partners. So if business A issue ordinary shares to the partners, then the value of those shares must be distributed among the partners in their profits and loss sharing ratio. So let me make that clear again. If a partnership is taken over, then the value of the shares that are being, ordinary shares that are being issued, must be distributed among the partners in their profit sharing ratio. And if there is a premium on this class of share, and when I say this class of share, I mean if there's a premium on the ordinary shares, then that must also be distributed according, that premium must also be distributed according to the partner's profit sharing ratio. However, if they decide to issue preference shares along with the ordinary shares to the partners, so if they're issuing preference shares, so let's say business A is issuing to the partnership preference shares, the value of the preference shares must be distributed to the partners according to the partners' last agreed capital balances. Okay? So if the partnership that is being taken over, if they were issued preference shares by the business that is taking them over, the value of those preference shares must be distributed according to the partners' last agreed capital balances, and any premium on the preference shares must also be distributed in the same manner. So we're looking at the different ways that the business can be paid for. In other words, we're looking at the takeover purchase consideration or the takeover purchase price. Also, any cash paid will be deposited into the cash or bank account to be distributed on closure. So if they paid cash, it's deposited into the cash or bank account to be distributed on closure. And if any loan notes will be issued to give to the partners an equivalent interest value benefit as under any partnership loan by that partner. So what they're basically saying that if they issue loan note, if they give loan notes, that has to be equivalent, the interest, they have to be equivalent to the interest that the partners would have received under the partnership for the loan that they would have had there. Okay? So we are now going to look at the accounting procedures for a partnership takeover. So when we are looking at the accounting procedures for a partnership takeover, what you would do, remember we spoke about dissolutions. And when we did dissolutions, we had several accounting entries for dissolving a partnership. We had accounting entries that looked at the realization of the assets. And we said that when you are realizing the asset at their book value, you will debit the realization account and credit the asset account. So we have to follow the same steps. So when the partnership is being taken over, we have to follow the same steps that we would have followed when we did when we were dissolving the partnership. So we are following those same accounting entries up to a point with a few modifications before sharing the profit and loss on realization. Okay, so let's look at some of those accounting entries again. Now, the accounting entry, one of the accounting entry, first one, when we were dissolving the partnership, we stated that we need to transfer the assets to be realized, which meaning, now, let me make this clear. The partnership is coming to a close, okay, and it is being taken over by a different business. So what that means is that the partnership has several books. There are books on their accounts on the books of the partnership. So the partnership has some accounts on their books. So for example, they will have assets, they will have liabilities, and they have their capital. So those assets and those liabilities that are on the books of the business will have to be closed off. So first of all, the first accounting entry when you're dissolving this partnership is that you have to transfer the value or the book values. You have to transfer the book values of all the assets to the realization account. And later we're going to look at an example question. And you have to transfer the values that you're given in the question from the statement of financial position, which are the book values of the asset, to the realization account. And how do you do that? You have to debit the realization account for the value and credit the asset account. So that's the first accounting entry. So I'm going through these again. The second one is to record the proceeds, or in other words, you want to record any amount of money you receive from disposing an asset or selling an asset, in other words. So if you sold an asset, then you will receive money for selling the asset. So to record the proceeds that you will receive from selling or realizing this asset, you would either, depending on if you're using a cash account or a bank account, you would debit either your cash or your bank account, and then you will credit the realization account. The third accounting entry is that you have to record the values or the value of assets taken over by partners without payment. So you're going to record the assets being taken over or taken by, you're going to record the assets taken by the partners. So let's say, for example, the partner took, you had some vehicles, and the partner took one of those vehicles at a value of $10,000. You have to record in the partner's capital account that vehicle that the partner took at the $10,000. It doesn't, do not look back at what it book value was, what it cost was. You just look at the value that he or she is taking it at and record it at that value. So to record assets taken by the partners, what you do is that you will debit the partner's capital account and credit the realization account. So that's your third accounting entry. Accounting entry number 4 is then that you have to record the cost of dissolution. So there is a cost usually associated with closing down a business. So to record the cost of dissolution, what you do is you debit the realization account, or you credit bank, and you credit bank or cash for that cost to dissolve this business or to close it. So sometimes you're given a dissolution cost. So to record the cost of dissolution, you debit realization and credit either bank or cash. Number 5, you have to record any money that you collect from your debtors or your accounts receivables. So any money that you would have collected from the debtors, you have to record that. How do we record it? By debiting either cash or bank, because we're receiving money, and crediting the accounts receivable or the debtors account. So you debit either cash or bank and credit the debtors account. Now, sometimes when you collect money from your debtors or your credit customers, you do not collect all of the money. So therefore, any funds not collected will be deemed a bad debt or a discount. Okay, and that portion that you did not collect will be then debited to the realization account. So you will debit the part that you did not collect to the realization account. So let's say that, for example, you had customers owing you $25,000 altogether collectively, and you only collected $24,000 from those customers. So when you collect that $24,000 from the customers, you will debit either cash or bank for that $24,000 and credit the accounts receivable. Now, in these questions, we don't usually draw up the other account. We make our focus the realization account, the partner's capital account, and the bank or cash account. That is our focus. We don't usually draw the other T accounts, but you can draw them as a way of trying to understand or to doodle, so that you will see the double entry clearly. So we received $24,000 from the customers. So we debit bank, credit the customer's account, which is the receivables. But then remember that they had owed us $25,000 overall, but we only collecting $24,000. So the difference between the $25,000 and the $24,000 is $1,000. That $1,000 will be deemed either a bad debt or a discount based on the question, and you will take that $1,000 and you will debit the realization account for that $1,000. So that's the accounting entry due. Similarly, number 6, when you have to look to record the payments of your liabilities or the creditors that you're going to pay, right? Or whatever, let's say it's a loan you're paying off, whatever, then you have to look to account for it. So how do you record the payment of your liabilities? To record the payment of your liabilities, you would debit the whatever liability account it is, you would debit that liability account, and then you will credit the bank or cash account because you're paying out money. Okay? Now, the same thing with your debtors is the same thing with your creditors or your liabilities. Let's say, for example, with respect to your creditors, that you did not pay the full amount to the creditors. Any funds not paid to your creditors will be deemed a discount. That portion will be credited to the realization account. So if you use the $25,000 that we used before for our debtors, let's say we owe the creditors $25,000 and we pay them $23,000 out of the $25,000. The difference between the $23,000 and the $25,000 is $2,000. That $2,000 will be deemed a discount received, and that $2,000 would then be credited to the realization account. So I trust this is clear. So then we are doing the partnership takeover. Those are the first steps that you would take in terms of the accounting entries for the partnership takeover. Also, then we would have to record the purchase price, and the purchase price, then whatever they're paying, the total amount that they tell you that they're paying for this partnership would then be credited to the realization account. Okay, so we can also, if you have the A-level accounting by Harold Randall, you can read chapters 8 on page 128 to 129, and then you can look at page 133 for the additional accounting entries, because Page 128 to 129 gives you the part when you're dissolving or closing down the partnership. And then page 133 will give you the other additional accounting entries for to complete. In other words, to complete for the takeover. Okay, so that will give you the other accounting entries. And remember that in your realization account, you're going to one side is going to be bigger than the other, so you will have a difference, and that difference will be your gain, as they're saying here, gain or loss on realization. However, when a company is taking over the business, there will always be a profit or a gain on realization. Okay, so now that we have looked at partnerships being taken over, we can look at the fact that companies can also be taken over as well. So you can have a company taking over another company, and some companies can be partially taken over by another company. In other words, they're not taking over everything. They're taking over some aspects of the business. So that's a partial takeover. When the company take over certain aspects of the business, and that's a partial takeover. And the shares are sold to the taken over company, and that investment, the investment that, let's say it is business A, company A is taking over company B partially. The investment that company A makes in company B would allow company B to still exist as an entity, because company A did not completely take over company B. Okay, so company A did not completely take over company B. So it will be called a partial takeover, right? Now, some companies also can be completely taken over. So if a company is completely taken over, that means company A is taking over company C, all of company C assets, liabilities. So some companies can be completely taken over where all the assets and all the liabilities are sold to the taking over company. So company A is taking over company C. So then company C will sell all of their assets and their liabilities to company A, and company C will then cease to exist. So then you only have company A. Okay, again, you can look at your Harold Randall text if you have it on page 227. And I am also going to read a little bit from that for you. It says a company may gain control of another company by purchasing more than 50% of the shares that carry voting rights in that other company. That normally means the ordinary share capital. Okay, so when you talk about voting rights, we mean those that have the ordinary share capital, and we're saying that is what they're referring to. Now, the company acquiring the shares will be known as the holding company. So the company that is acquiring the shares will be known as the holding company, and the company whose shares have been acquired is a subsidiary company. So again, we go back to our A and C. A is partially taking over C, so then A will be known as the holding company, and C is the subsidiary company of the holding company. Now, when the holding company owns all the issued shares in its subsidiary, then the latter is known, which is company C, will then be known as a wholly owned subsidiary. Now, if so if let's say that A owns less than 100% of the shares in the subsidiary, then the shares which it does not hold are held then by what they call a minority interest. So you will get a minority interest. So in the balance sheet, this is important. In the balance sheet of the holding company, so which is company A, using that example again, the shareholdings will be shown on the assets, fixed assets or non-current assets is shown under there as an investment. So you usually have an asset in your statement of financial position. When there is a partial takeover, you have an asset called an investment when you have that partial takeover. So when you're looking at the complete takeover now, what happens is that the net assets of the taken over entity must be closed off to the realization account to determine the profit or loss on the closure. The capital section of the taken over entity must be transferred to an account called the sundry shareholders account on closure. And the taken over entity no longer exists, because if it is business A taking over business B will cease to exist and you only have business A. So again, that company, business B, will no longer exist, and the goodwill on the seal must be established, which means you have to work out what the goodwill would be on the seal. Okay, so when you're selling the business, then you have to work out the goodwill. And how do we work out this goodwill? You work out the goodwill by taking the purchase price, what they're calling here the purchase consideration, and subtracting the values of the net assets taken over. So they usually give you a set of values and say, well, the business has taken over these net assets at this value. So you have to take that value and subtract it from the purchase price to get your goodwill. Now, if the value of, I want to make sure that I'm stating this clear, if the value of your net assets is greater than the purchase price, you will have something called negative goodwill. If you go back to your previous notes or what we would have taught previously, you will see that we spoke about negative goodwill. Okay, and in this case, the value of your net assets are greater than what the person is willing to pay for your business. So then you have negative goodwill. So when that figure is negative, you don't say bad will, it is negative goodwill. And this could be recorded in the statement of financial position as an intangible asset. However, when you're recording that negative goodwill as an intangible asset, you have to record it as a negative figure so you know that it has to be subtracted. However, you can also record that negative goodwill in the finance by section of the statement of financial position, and you record it not as goodwill this time, but you record it as capital reserve. So you can either put it as negative goodwill and put it as a negative figure under your assets, or you can put it under the finance by section as a positive figure and call it capital reserve. Okay. Also, the net assets of the taken over entity is then combined with the net assets of the taking over entity in the statement of financial position. So in this case, a company is taking over another company. So then they're stating that the assets and liabilities, those are combined for both businesses in the statement of financial position, and the purchase consideration must then be accounted for in the combined statement of financial position. So look at it as a complete takeover of a company. Again, the partial takeover, the shares of the taken over company are sold to the taking over entity in accordance of the taking over company stipulation. This sounds a bit confusing, but basically what they're trying to say here is that the shares of company A will be taken over by company B if that is what is happening at company B's stipulations, how they have stipulated it. That is how it will be done. And finally, the purchase consideration will be recorded on the statement of financial position by the taking over company as an investment under non-current assets. Okay, so that investment that the company will have in the subsidiary will fall under your assets. And the shares and the structures of the purchase consideration will be shown in the taken over company statement where appropriate. So basically what this has done is bring us to the end of our presentation on takeovers, and I will be looking at an example question called Pam, Lam, and Tian, so that we can get a practical example of how it is done when a company is taking over a partnership. So we will look at a practical example, and I want you to review all your notes on this topic, read and research about takeovers, and read the chapters or read the pages that were given using the A-level accounting Harold Randall on this topic. Thank you.